Hello and welcome, everyone. We are just going to give it 10 to 15 seconds to allow folks to trickle in here before we get started. Really appreciate everyone joining on time today. Hope you're having a wonderful Thursday afternoon or morning if you're calling in from the West Coast. Um, I see that number ticking up, so I think we're just going to dive in here since we have a full agenda today. Thank you so much for joining. My name is Craig Kornblum. I'm the Program Director at Clean Energy for America. Two quick notes right off the top. Today's conversation is being recorded, so you will receive a link to that video shortly after today's conversation. And additionally, for any reporters on the call, please note that this conversation is off the record. If you'd like to be put in touch with one of our panelists, please reach out to info@ceforamerica.org. That email will be dropped in the chat for your reference. But with that, we are very excited to co-host today's webinar on transferability with Crux and Pioneer Public Affairs. We have a great presentation and conversation for you today, and we'll save the last 10 or so minutes for questions submitted by you. So if you have a question for any of the speakers, please use that Q&A function at the bottom of your screen. We will do our best to answer as many of those as we can. But without further ado, on today's panel, we have Rob Parker, Chief Commercial Officer at Crux, Rob Rains, Senior Vice President at Washington Analysis, Scott Pearl, Principal at Global Infrastructure Partners, and last but not least, our moderator today, Cassie Rowlands, the Chief Finance Director at Pioneer Public Affairs. Over to you, Cassie.
Thanks, Craig. Hi, everyone. Like Craig said, I'm Cassie Rowlands. I'm Climate Finance Director at Pioneer Public Affairs, and I'm here to provide some scene setting, and I'll also be moderating the Q&A portion of our session later on. Before the IRA, Congress would spend months negotiating and horse trading for 1 to 2 year tax credit extensions. When they extended the ITC and PTC in 2016, the budget score was around $25 billion for both over 10 years. Today, we're looking at that as the annual market that could shoot up to $100 billion per year in coming years. Before the IRA, the idea of transferability was basically unimaginable. When the IRA was being debated, there were skeptics, including lawyers, industry, tax credit, finance experts, and tax nerds like ourselves, who said it wouldn't help much. Today, it's becoming the go-to way of financing tax credits, as I'm sure you've heard. It's been a pleasure to learn from the Crux team about the market they're building and the immense knowledge about clean energy tax incentives they now possess because of all of their data. I'm excited they're here and willing to share that insight with you and help us all appreciate how transferability is making tax credits an even more important tool for clean energy deployment. With that, I'll pass it to Rob Parker to explain how transferability transactions work on Crux's platform and describe what's happening in the market and how it's performing at this early stage. Rob, thanks for being with us.
Great. Thanks so much for the intro, Craig and Cassie. It's really nice to be included in this. I'm going to start by presenting a few slides, some basics on the IRA and transferability, and we'll then go into trends and sort of how we're seeing this market develop. So we'll start on page 4. There are really 4 key aspects of the IRA as it pertains to tax credits. They are more generous than ever before. There is more certainty. So there is now a 10-year runway of tax credits at a minimum, really enabling buyers of tax credits to develop programs around this. There are many more categories and types of technology that qualify for tax credits, and we'll go into that further. And really, most importantly, and kind of topical probably for this conversation, is the introduction for the first time of transferability, which means the ability of those who create tax credits to sell them to someone else who may actually need them, and kind of potentially avoid the need for the sort of PhD in finance thesis projects that tax equity has been in the last couple of decades. So on the next slide, as I mentioned, dozens of technologies can now access these tax credits, no longer limited to more or less wind and solar projects and sometimes storage. And with bonuses or adders, as that you may hear them being called, that can get stacked on top of them, these tax credits can increase from 30% of the investment amount to 40 or even 50% of the investment amount in many cases, which is really just game-changing for the industry and the energy transformation. On the next slide, all of these credit types can be transferred. In that transfer, there are a few sort of nitty-gritty details that matter. There's some interesting complexity around the tax year and when the credit's generated. Interestingly, these tax credits can be carried forward and backward, so 22 years forward, 3 years backward. Interestingly, they can be sliced and diced vertically. What this really means is they can be syndicated. So if there's a mega project generating $100 million a year of tax credits or a $300 million a year investment tax credit, they can be tranched and syndicated. However, they cannot be what the industry calls sliced horizontally, which is you can't separate the base tax credit from some of the bonus adders like energy communities or low income or other or domestic content. They have to be kept as sort of a neat vertical slice. So maybe a little bit different from traditional syndication. And then lastly, the transferee or the tax credit buyer must be a C Corp or have passive activity income. And so this generally, in a lot of cases, for example, limits on family offices, hedge funds, PE funds, and also S corporations. So there are some limitations on that. Lastly, of note on this slide, certain types of tax credits have the option to elect into direct pay, which is effectively get a check from the government. Now, some of those that are even eligible for that are choosing to go transferability and sale anyway. Maybe there's a time value and not wanting to wait for the government to process it. There's also a more limited number of years you can receive direct pay for, and there's some interesting timing around when you want to elect the direct pay stream versus transferability. But really only a couple of these tax credit types, effectively hydrogen, which is V, carbon capture, Q, and advanced manufacturing, 45X, are eligible for that option in the first place. On the next slide, really just a quick piece to highlight here, these tax credits aren't just sort of after the fact, although they are, I guess, in some cases found money, but not really. They are a critical part of the cap stack of projects. This is really critical to monetize this in an effective way to finance a project. Developers and vendors know this exists, it's being priced in, and there's now really an expectation of monetization on the part of developers. Traditionally, if you think about it, traditional tax equity is called now, you had to fit into a neat little box to receive that financing, but there's sort of a risk return frontier that exists in transferability where most every project, even ones that are maybe merchant or more challenging markets or new technologies, there is a buyer for most every type of tax credit. And that is very different from how the market worked before transferability. Moving, I think, to page 9, as we shift kind of what does the market look like today? So last year was the first year of transferability. It was legal Jan 1, but effectively deals didn't really start happening until August. That's when final guidance started coming out from Treasury. However, in what were only a handful of months in the first year of existence, we estimate $7 to $9 billion of tax credits transacted in 23, which is really astronomical for kind of a first year of a market. This year, a lot of estimates are estimates, I think, in others, and $20 billion plus. And I think Cassie noted this earlier. Evercore had a note and others on this. There's a forecast of over $100 billion a year of tax credits across the various types by 2030. The reality is no one actually knows because almost all of these credits don't have a cap. And so really it just depends on growth of the industry, manufacturing, and other kind of other aspects of the market, which is really fascinating. On the next slide, I mentioned guidance. So final guidance came out just this past April. Initial guidance came out in late summer, and that's when transactions happen. And that's when we saw a massive increase in buyers come to market. But what really happened is final guidance came out, and now this, initial trickle has become just a giant wave of buyers coming into the market. And it's not just Fortune 500s. It is the Russell 2000 companies. It is, the shocking number of private companies that have $50 to $100 million a year of tax liability they want to offset. Small businesses, public or private, family offices that have passive income. And it's really been game changing for the industry to have all this capital come in. On the final guidance, and this is, net good from a certainty perspective, although I'm sure everybody had a wish list of potential changes, but there were really no material changes to guidance between initial and then final guidance that just came out. As far as Crux, we have over $9 billion of tax credits on our platform across almost every tech type, I think every tech type but nuclear. And then we've actually had more than $3 billion of bids just year to date. So now in 5 months of the year. So as you can see, that the market is just accelerating rapidly. On the next slide, kind of some of the trends here are interesting, and I think we're certainly surprising to us, and I'm sure others as well. Probably the biggest takeaway is, if you look at the pie chart, less than half of the market for tax credits come from the traditional technologies people think about. Wind, solar, storage, although storage didn't have tax credit on a standalone basis before. The other half, more than that if you include standalone storage, comes from new technologies. Advanced manufacturing, we've identified a massive number of tax credits that come out of advanced manufacturing. Those are new manufacturing facilities in the US that produce qualifying components for renewable products. Biofuels RNG has been a surprising sector as well. We're accounting for almost 10% of the supply that we've identified as well. And so all that new stuff was not, well, one, was not eligible for tax credits before, but two, most of it doesn't fit in the tax equity bucket anyway, right? And so that supply is almost all going into the transferability market. And it also is noted here, we have closed transactions across a variety of these technologies, and I think we have listings for every one of these technologies on our platform today. On the next slide, a little on risk mitigation. And this maybe is an area of distinction from other types of historic investment in the sector. The vast majority of transactions in investment tax credits have tax insurance. Tax insurance covers a couple of the risks that do exist that makes this different from other types of tax credits people may know, like LIHTC or state and local film production. There's this risk of recapture where the government, if there's a change of control, the government may seek to recapture some of the credit. There is a potential for the government to challenge the basis that sets the credit, and how the commercial structures have evolved to manage this risk is through insurance. And 3/4 of all deals so far have that insurance. So what deals don't have insurance? Generally, it's when the seller is investment grade or can provide an investment grade guarantee. And so you are seeing developers with that rating, which is the minority of developers, as folks can imagine, are offering a parent guarantee. And there is obviously a lot of value saved in doing that. Because of this recapture and basis risk, almost all ITC deals have to do what's called a cost segregation report, and they have an appraisal. They want third-party verification of what is setting the eligible basis for that. And then we see legal opinions or memos in most deals as well that are investment tax credits. On the next slide, a little on the impact. It's pretty hard to overstate this. If you think of the old market for tax equity, maybe you had 50 players in total, but really 10 that dominated the market for tax equity. And today, it's not just these Fortune 400 companies. It is everything in the middle, the big, medium, private companies and family offices that we have transacting right now. There are really thousands of companies that are looking at doing this. And if you ask me my personal view, if you fast forward the clock a couple of years, I think you can see how this quickly shifts to a scenario where shareholders and boards start asking companies like, why aren't you doing this? Like, this exists, the risk mitigants exist. You can save 5, 10, maybe more % off your tax liability. And there's also, of course, the ESG component of this. And I think we're already seeing, and we'll continue to see way more companies transferability market than we ever saw in the tax equity market. Deals can close quickly. If everybody has their ducks in a row, we've seen deals close in under 4 weeks, which is remarkably fast by any type of financing standard. And again, that's because even though this is in some ways a financing, it's documented to look a lot more like a commercial transaction. And then lastly, deals are being split, big deals are being syndicated, and that's a role that a lot of intermediaries take as well in the market to kind of help provide that liquidity and facilitate those. On the next slide, a little on competition and sort of speaking a little bit to benefits of listing on a platform like Crux. How to read this is 29% of tax credits listed on Crux received an offer within 1 week of listing. Of those, 53% had multiple bids. And so, you kind of go forward here, almost 70% of tax credits, and this is actually now old, and the number's probably even higher than this as a percentage basis, had a bid on Crux. And of those, 40% had multiple bids. And how I think about that is, you think of kind of like the shape of a normal distribution. If you're a deal in sort of the fat part of the tail, you want maximum exposure because you want all those bids. You want to find the maximum best bid, and you want to find the best buyer there. And price is certainly a key factor, but there are other non-price factors that matter as well. And you want to find the one that matches your needs the best. Similarly, if you exist sort of on the long tail, you really need that exposure because you want to find the right buyer and you want that widest exposure possible to do that. And oftentimes projects don't really know where they sit on that curve until they list and find out. But from our experience, there are much better outcomes by listing and having competition and sort of exploring avenues that are out there. I think on the last slide, the pricing. Maybe one of the interesting observations that I've noticed is just how quickly the market is tiered. And so, how we often talk about this kind of, actually I'll go from the right to the left, is sort of there's this premium risk-free equivalent to the market, which tends to be a spot market production tax credit, which has no basis or eligibility risk. You kind of look at a meter, what was generated, we're done, or something with an investment grade guarantee. And those trade in the mid upper 90s generally. From the next one down, we see sort of smaller deals, non-investment grade developers, and those trade a little below that. Those are generally smaller developers. The next one down is sort of this premium bucket of investment grade ITC, where you have some of these risks that are introduced, but they're mitigated through insurance or a strong developer, and those have a little bit of a wider range, kind of 90, 95 cents. And then from there, kind of smaller deals, as you can imagine, not only is there potentially more risk, but also just the juice has to be worth the squeeze. To pay lawyers, to do the work, to focus, there has to be enough cash in the deal for the tax buyer to have it make sense. And so then you start to see prices begin to decrease a little more. And then lastly, there's sort of this bucket of new technologies. And then on the next slide, kind of what next? What do we see? I think we see as more deals happen, as everyone gets a few reps in, as legal documents get shared across the industry, deals will move faster. There'll be more standardization around process and around diligence. Everyone will agree on what is the set of documents and what do we need to see to do this? What are the key terms? What are the things that matter? That's actually one thing that Crux does to help, for example, is we actually offer standardized transaction docs free as part of our platform. Folks can use them. They don't have to, of course, but it's certainly we offer, and I think most people benefit from that. More control, especially bigger developers, will start to see more, or have been seeing more of a premium, which is to say leveraging potentially an investment grade rating. And the money that would go to the insurance company, buyer and seller can split that, both end up better off. We do see a tighter market. And I think that we definitely saw an incredibly tight market in 23, where those tax credits traded higher than pretty much anyone in the sector expected. Some of that driven by just not much supply because a lot of eligible projects had already financed themselves previously. But also just more buyers came in faster than expected. And then in 24, we have continued to see, surprisingly, a market that is probably short good quality supply. The buy side is growing very fast as folks come into this market. And then lastly, price efficiency. I showed you on the previous slide how tax credit prices have already sort of bucketed. And I think we're going to see those prices get even finer and closer as the market standardizes, as everyone has some of the same terms, as people use insurance. So they say, hey, this is an A-rated guarantee versus a B-rated guarantee. And, we think a couple of digits will be added to prices. And the distinction maybe moves even further from price to potentially other non-price terms in making or breaking deals. So with that, I guess I'll hand it back to Cassie.
Great, thank you. The insights you guys have shared and the trends and data you all have gathered so far is really impressive. And on your last point about deals moving faster than 4 weeks is really incredibly fast. So it's already at a pace that I'm surprised by. So that's really impressive to hear. I want to open it up a little bit now to have some Q&A with Rob Parker, Rob Rains, and Scott. And I'll start with you, Scott. What role do you think transferability has on improving the bankability of energy transition technologies and projects?
Sure. Thanks, Cassie. I think as Rob alluded to, and maybe what's not widely known is that the ultimate effect of the IRA is really going to be driven by the ability to monetize tax credits. We at GIP, we're one of the largest sponsors right now of traditional tax equity finance projects through primarily our renewable power businesses. And we're well aware that the traditional players in the market, particularly the financial institutions, have a limited size as it relates to their ultimate tax appetite. It's really in the low tens of billions of dollars versus the 100 that you quoted, Cassie. So if we were going to stick with the historical construct, really the ambitions of the IRA would be challenged to be realized. And actually, that traditional tax equity appetite might even be further pressured by increasing capital requirements. Remains to be seen. At the same time, Rob talked a lot about the demand. I see a lot of supply coming, whether that's increases in the traditional onshore wind and solar, and now battery storage standalone has been added. You start to have some of the large offshore wind projects that will be coming to market, and each one of those projects can be hundreds of millions or even billions. I mean, really, really big demand. And that's before we're even getting to the hydrogens and the carbon captures of the world, which, as Rob mentioned, have some access to direct pay, but really those projects don't pencil unless you're able to monetize the remaining 5 or 7 years. So I think transferability has the potential to be a real game changer, and really is needed to make the projects that I'm looking at work. It's also an effective way for taxpayers to make what are attractive investments in clean energy projects that they wouldn't otherwise have access to.
Yeah, that makes a lot of sense. Thanks. Rob Brains, from your standpoint, what are the most common questions investors have regarding transferability?
Thanks, Cassie, and Rob Parker, thank you for such a great presentation. The things that we, generally speaking, there are kind of themes with the folks that we work with around IRA. I think chief among them are the pace and clarity of tax guidance as it's being released by the IRS. With the election looming, with the polls indicating a very close presidential race, and potential implications for the IRA post-election, I think that investors in the space are interested in sort of I guess I'd say the sanctity of the tax guidance as it's being issued, and the integrity of these kind of nascent markets, including transferability. That would be kind of, I think, paramount within the within the space. In addition to that, there are specific buckets of technologies. Scott mentioned offshore wind projects, for instance, where the guidance is particularly critical in order to support the economics that have been challenged in that space. Hydrogen's another one. There's a lot of folks that are trying to get really ambitious hydrogen projects off the ground, and for them, it's really critical. It really affects their project financing to know how much support they can receive through the IRA. So those are 2 or 3 things that I would highlight as it pertains to the investment community and their interest, and then potential, I guess I'd say, concerns, or maybe slight anxiety around the integrity of the IRA going forward.
Makes sense. Let's go back to Rob Parker, and some kind of Crux specific questions. Can any business buy a tax credit on Crux? And can anyone see the data that you showed, and kind of the transparency for some of that data in the market today?
Sure. So first question first, I guess. Any C corporation or individual with passive income is eligible to buy tax credits today. We have listings of tax credits, literally $25,000 rooftops up to $500 million ITC from a single project. And there are buyers for all types of those projects. And so we host all of those transactions. So again, just where it gets interesting, and consult your accountant, which I am not, if you are an S Corp, closely held corp, or other flavors of non-C Corp, or have certain types of income. Sorry, remind me the second question. Part 2 of that one.
Questions on the kind of transparency and
yes,
that's the data that Crux has.
Yeah, absolutely. So we are collecting incredible data, and our goal in this market is to bring liquidity and transparency to the market. So we look to share that data with the market in many ways. One of those is sort of helping deals transact faster by aligning buyers and sellers on like what is market pricing. That does not exist in the tax equity world today. But a second is we publish very comprehensive materials on our website. I think folks on our team, Katie and Emily, and others who publish our insights do really an amazing job. And I kind of point folks first. We put out really the industry's leading kind of guide, or we call it our market intelligence report for 23, where we identified over $3.5 billion of specific tax credit transactions in 23 alone. And we put out sort of an 80-page report that really drills down into those by size, technology type, sentiment for buyers, sellers, intermediaries, other factors. And we put a quarterly update out a month or so ago, and we'll put a half-year update out soon. And so we will continue to share those insights with the market as much as possible and as many ways as possible.
That's great. Thanks. Those are really great resources. Scott, let's go back to you. Kind of broadening out in scope again. What initial impact have you observed the IRA having on some of the hard to decarbonize sectors and projects?
Sure, Cassie, and I think as Rob mentioned, that's really a newer product offering and something that the IRA has had a meaningful impact on. So taking a step back, we're a global investment manager, and we look at opportunities around the world. When the IRA was passed in 2022, the focus on these difficult to abate sectors, or new energies as we call them, increased substantially and started to draw a lot of attention to the US from global players. The IRA has the potential under the 45V to which is the hydrogen credit, to make the US the low-cost producer, and the expanded carbon capture credits under 45Q are attractive relative to opportunities globally. Also biofuels, those tax credits under Section 48, they're potentially attractive and helpful for investment. I would say some of the shorter duration production tax credits, are a little harder to underwrite against, and one's got to take a view on their ability to be extended, but also additive nonetheless. Since the law passed, it was a slow process for the Treasury Department, as Rob Raines talked about, to produce the required guidance. And there have been some idiosyncrasies, particularly in hydrogen. They're requiring hourly matching for zero carbon power. That's quite complicated and can be challenging to achieve and more expensive. It's a bit of a puzzle, that logic, because it's not required for other elements of the IRA, such as electric vehicles. There's some unintended consequence. It pushes activity from green to blue hydrogen, although there's some open questions in that regard as well. I think big picture, still some uncertainties with a number of these sectors until we get the final guidance. Developers are moving forward. I think hopeful that they'll get to the right place through an iterative feedback process with industry. And still, the IRA and these tax credits are a big improvement over what existed historically. I think the world's just dealing with a little bit of a hangover from it's not as good as it seemed originally, as we kind of work through the real world details of how this turns into monetization.
Great, thanks. Rob Raines, as an analyst, what impact do you see this transferability mechanism having on the clean energy industry? Is it helping drive new technologies or manufacturing sectors? What are you seeing?
Well, it's obviously quite significant, and we would rely on some of the terrific data that Crux has put together through its position as a platform for performing the price discovery around these credits. The proof is in the pudding. Obviously, deployments of clean energy in the US are quite high, particularly around solar power, although onshore wind has been a significant laggard relative to that other technology. Offshore wind, as Scott had pointed out a little bit earlier, has also had some turbulence in terms of projects getting online, although that is starting to happen. 45X in particular, and I'm drawing from Rob Parker's great PowerPoint, There's been a lot of announced new CapEx around projects, and I would assume that having the ability to transfer these credits can help kind of provide developers with a new way to reduce their risk as they move forward with projects. Obviously, having platforms like Crux, for instance, is important in terms of price discovery too. And I think that that's really critical to get all kinds of different buyers comfortable within the clean tech space. And I do really feel like deeper pools of capital being available through some of these different mechanisms in the IRA will help facilitate a faster decarbonization trajectory. And I think that that's bearing out over time. In terms of some of I talked earlier a little bit about some of the more nascent technologies that we're not entirely sure where they'll fit in our generation mix, like hydrogen, or maybe I guess I'd throw in offshore wind there a little bit. Although I think that could be a situation where it's very low. There's very low deployments at first, and then there's a big burst of them as we get closer to the end of the decade. So overall, it's obviously very positive, and there's a lot of excitement around it, and it invites a whole new pool of the investment class to participate, which is always good, and I think lifts all the boats within the space.
That's great, definitely. Thank you. Rob Parker, let's talk about step-ups. So how are companies able to access a step-up in basis? Do they have to rely on tax equity financing, or can they get a step-up when using transferability?
Firms are exploring getting step-ups right now in the market using transferability. The cleanest way, and also I'm not a lawyer, to do this is to bring in some third-party partner. But they don't have to be a tax partner, right? So there's folks now that are pursuing investments in kind of this minority interest preferred step-up partner, where they come in through some structure or in a return in some manner, and they enable as true third-party money to effectuate an increase in valuation. On top of that, those are usually supported, again, by appraisals and cost seg reports from independent accountants as well. But we are seeing that increasingly in the market.
Great. And what percentage of projects use financing to monetize their tax credits? What are you all seeing?
Sorry, which percentage of projects?
Sorry, related to step-ups, I think I went off.
That is a good question. I actually don't know the percentage of projects that have a step up, but I would say it's probably more than half. It tends to be the larger projects, the more sophisticated projects, developers that have partners that help effectuate that, or kind of other structural mechanics to do it. I will say that what we've seen so far, and there's a big caveat here that probably Rob can speak to better, that we haven't seen like an IRS audit cycle yet. So I do think we've probably seen step-ups in the market that are higher than the tax equity market was comfortable with and historically did. And so I think time will tell how that bears out. But what's interesting is this kind of goes back to how this market's different than it's insured. And so if you're a buyer, your economics are probably covered by a mix of insurance or investment grade guarantee, and then it just becomes like a headache. And how much do you value the risk of having to deal with that IRS headache? So it is a very different scenario, I think.
Great, thanks. I'm going to turn to some of the audience Q&A. We've got an active set of questions here. So one is, what share of the tax credit transfer market buyers used to be the tax equity market leaders? What is the share today, and how does this need to evolve?
Yeah, that's kind of an interesting question. The tax equity isn't going away. That's the interesting thing. I think the sector growth is so much that, frankly, the demand for tax equity, traditional tax equity, is still increasing. And on top of the increasing demand for tax equity, you have this massive, that didn't exist before, demand for transferability. So I think if you were to talk to all of the traditional tax equity banks, they all would tell you, we're very happy right now. We have more deals than we can handle. There's too much demand for tax equity, and so we're still very happy doing tax equity. On top of that, they are also involved in kind of tax credit transactions sometimes. But what's interesting is, what was kind of like the old partnership flip or P flip has evolved into what kind of the industry is calling a transferability flip or T flip, where it's probably unlikely anyone's getting a tax equity deal done today where the bank doesn't reserve the right to sell the tax credits out anyway. So they may structure a tax equity transaction, but then they'll sell the credits and very often pass on some of that price risk to the developers or charge another fee. At the same time, we're actually working with some of those tax equity providers to help manage the tax credit transfer process of it. So it's actually not like a replacement so much as different folks that are doing the deals and kind of where the credits are coming out of, because the tax credit themselves aren't new. What's new is they can be transferred.
Yep, makes sense. Rob Brains, I think this is a good question for you. Simply making the tax credits refundable would have achieved the most renewable energy development for each tax dollar invested. Was refundability seriously considered as an option, and is there still potential to introduce it?
Well, some of that did make the final cut, obviously, although it was parceled off, so only a portion of eligible folks are able to perform refundability. I think that this was a remarkable effort in trying to identify compromise, essentially with like 1 or 2 Senate offices. So I think it was a matter of what was palatable to the gentlelady from Arizona and the gentleman from West Virginia. So I do recall that there were a lot of things floated around, including the SEP proposal, if you remember correctly, the clean energy performance, whatever the mechanism was to push utilities towards decarbonization. I think in the unlikely event of, say, like a Democratic trifecta in 2025, that could be something that is revisited through the reconciliation process, which is how IRA got adopted. But yes, I think that was just your sort of traditional kind of horse trading that takes place when you have major pieces of federal or even state legislation.
Thanks, yeah. Scott, maybe this one would be good one for you to touch on. As large buyers fulfill past tax liabilities by purchasing 2023 and 2024 credits, how do you think this affects the future demand and price of credits?
Well, I mean, I think that I think there certainly is quite a bit of supply that is going to be coming to the market over the next couple of years. A lot of projects that are in the works. Now the economics of these transfers needs to be sufficient to make them pencil out. Certainly looking at some of the statistics that Rob has been sharing and the momentum that has been experienced, we're certainly encouraged by the rapid growth in the transferability market. We're also encouraged by the dynamic that Rob mentioned about the traditional players, frankly, expanding their efforts to not just fund the P-flips, but also the transfer market. I think the momentum here is making good progress and bodes well for the demand for these credits materializing to support and facilitate the developers and projects that are seeking them. I mean, the markets, you never cease to be amazed by how efficient markets can be, and so I think that was the theory and the hope in including that transferability provision, which I'm sure Rob Rains also knows the background on, and it's nice to see it actually materializing in the real world, maybe even a little quicker than folks would have imagined.
Great. We've got a couple questions about some larger kind of policy issues and how they impact transferability. So I'll throw this out to the group, and whoever wants to answer, please feel free to jump in. How do you see the Basel III capital requirements on tax equity affecting the transfer market?
So when I'd alluded to earlier the issue for traditional tax equity, that was top of mind. It's as currently published. It's an issue, but ultimately at least to our knowledge, everybody's aware of it. The regulators here in the U.S. are being made aware of it. I think from a fundamental logic standpoint, the issue would be treating these deals as like true private equity kind of risk deals versus something that is much, much lower risk due to everything that Rob Parker was talking about, the ability to insure these transactions, really the level of certainty in terms of delivering the tax credit. I think when properly educated, I'm hopeful that the regulators here will recognize that this isn't applicable for the for what's suggested under Basel III, and that obviously comes out of Europe, and they don't really have a tax equity market there. So, we're hopeful that it'll get sorted out. But ultimately, when you just look at the numbers, one's expecting the transfer market to become the bigger bulk of activity over time in any event.
Yep, definitely. Another question, how does the Greenhouse Gas Reduction Fund capital impact transferability? Will this just have the potential to increase the number of projects to sell credits to the buy side? Rob
I'm
Rains?
not really sure. The Greenhouse Gas Reduction Fund, this is an EPA program, is it not? I'm just not following it very closely.
Okay, yeah.
Yeah. I mean, I'm happy to, if the person wants, they can reach out offline, and happy to kind of look into that a bit further. But obviously, it hasn't been a deterrent so far.
Yeah, I think under the GGRF, there's Solar for All, and there's a number of entities that are going to be issuing grants and other funding streams, so that there's more solar going out there. There's more other types of projects going out there. So I think the question is just getting at having a lot more supply.
Yeah, and Cassie, to your point, one of the transformative things I think about IRA that program underscores is there's just so much money that's coming out of the federal government right now to support clean energy. It's completely unprecedented. And we've seen this transformation, particularly at the Department of Energy over the last 15, 16 years or so, from essentially an agency where a lot of research and development was being performed, and management of weapons, to basically a grant-making agency, essentially, most of it. And it's now kind of bled over into other agency work like EPA, for instance. So kind of anecdotally, what you see is the federal government and key principals are working very hard to deploy these funds in the event of a changeover in administration, not unlike any other election year where an administration is trying to cement kind of legacy legislation or programs. But I'm just not familiar with kind of how that pool of money is affecting kind of the broader market. But I do think it underscores kind of that major change in the federal government's priorities, and the ability for folks to tap those funds.
Yeah, definitely makes sense. Let's end on a Crux question for Rob Parker. Are Crux's standard tax credit transfer agreements publicly available? Is there any movement to create an industry standard set of publicly available model tax credit transaction agreements akin to the NVCA model docs that have been used with great success to reduce friction and transaction costs in venture capital transactions over the past few decades?
Yeah, I love this question. I'm actually not familiar with those specifics, but I mean, in the power sector, we have ISDAs and EEI masters and lots of forms. And I absolutely think this is where the market industry should go. I think we're already seeing very quickly, as kind of forms get exchanged between law firms, that a lot of key structural elements are becoming similar slowly. And then really most deals that we see come down to hammering out like a half dozen commercial items. But definitely, I think having a public set would make that happen faster. So right now, they're frankly available kind of under NDA to folks on the platform. We have had discussions about just putting them out there publicly, and I'm glad you asked that question. We continue to have those discussions, but haven't decided yet. But stay tuned.
Great, thanks. And one last question that came in here. And I think Scott, I think this one would be a good one for you. When monetizing the ITC with transfers, what happens to the depreciation? Is that monetized separately, or is that left with a project and used by the transfer project somehow?
Yeah, that is one interesting element of the transferability market. So in the P-flip transaction that Rob Parker referenced, you are able to have the traditional tax equity provider pay you money for utilizing the depreciation shield generated by these projects, and the renewable projects, generally speaking, have fairly favorable accelerated depreciation characteristics. Oftentimes, if it's a true project, not part of a larger business, you're not generating net income in the very early part of the project, so you would otherwise wait several years to monetize that depreciation yourself, which has some time value considerations. But the other wrinkle with traditional tax equity is you have some fairly strict limitations on what you can do at the project company in terms of putting project debt at that level A, and then B, there's a little bit of a cash strip that goes to the tax equity as part of their investment in the project, and so when you kind of take out that cash strip that has to go to the traditional tax equity partner and just focus on monetizing the transfer tax credit, that has an impact of offsetting the loss of the time value on the depreciation, and you have to look at it on a project by project basis. But net there are some offsetting factors related to your flexibility under transferability, and of course, the price that you get for your tax credits is also very important in weighing the different considerations. So it's something that isn't part of that transaction, but there are other advantages that can offset it.
Great, thanks so much for those insights. Let's turn it back to Craig to close us out. Thanks everybody for sharing your thoughts on our panel, and thanks again, Rob, for the great data and analysis.
Thanks, Cassie. And thanks so much to Rob Parker, Rob Rains, Scott Pearl, Cassie Rowlands, and the teams at Crux and Pioneer Public Affairs for making this discussion possible today. If you have any questions that were not answered, or you have additional questions for the panelists, please reach out to info@ceforamerica.org. This conversation was a great reminder that as transformative as the IRA has and will continue to be for the clean energy industry, congressional Republicans have still been trying to repeal all our parts of it since the day it was signed. So we all need to be out there singing its praises loudly and frequently. So thank you so much for joining. Stay tuned for more content like this from CE4A in the coming months. Thank you, everyone, and have a great day.
You too, thank you.